Japan is carrying a set of numbers that, according to standard economic theory, should not be survivable. Government debt has exceeded 260% of GDP, the highest ratio among advanced economies. Policy interest rates remained near zero or negative for more than 2 decades. The Bank of Japan now owns over 50% of all outstanding Japanese government bonds. The Japanese yen has lost roughly 45 to 50% of its value against the US dollar over the past 10 years. In most countries, this combination would trigger a familiar sequence: a sovereign debt crisis, currency collapse, banking system instability, capital flight. Yet Japan shows none of these outcomes. There has been no default, no episode of hyperinflation, no systemic banking collapse, no sudden loss of financial control. The economy continues to function. Social order remains intact. The system holds, even as long-term growth remains subdued. This raises a more uncomfortable question. Is Japan an economy that has already failed but learned how to survive failure? Or is it something else entirely? A controlled environment where debt, demographics, monetary policy, and social stability are being pushed to their absolute limits, years ahead of the rest of the world. If so, Japan may not represent an exception. It may represent a preview. Japan did not fail, it reached the limit first. Japan is often described as a failed economy, a country trapped in stagnation, buried under debt, unable to grow. That framing is inaccurate. Japan is not an economic failure. It is a debt system that reached its structural limits earlier than everyone else. To understand Japan's position today, the first mistake must be avoided: treating public debt as a moral failure or a policy error. Japan's debt did not emerge from recklessness. It emerged from demographics, savings behavior, and a specific post-bubble survival strategy. Debt without capital flight. Japan's government debt exceeds 260% of GDP, a level that would be catastrophic for most countries. But Japan does not fund this debt the way the US, Europe, or emerging markets do. More than 90% of Japanese government bonds are held domestically by Japanese banks, pension funds, insurance companies, and the Bank of Japan itself. Foreign ownership remains below 15%. This single fact changes everything. Japan is not dependent on foreign capital inflows to roll its debt. There is no external creditor class capable of forcing liquidation through rising yields or sudden withdrawal. The Japanese state borrows primarily from its own population, directly or indirectly. Aging society, shrinking demand. Japan's debt trajectory is inseparable from its demographics. Japan is the oldest major society on Earth, with a median age near 49, more citizens over 65 than under 15, and a population that peaked around 2010 and has been declining since. An aging population behaves differently from a young one. Older societies consume less, borrow less, and prioritize capital preservation over expansion. Private demand weakens structurally. As consumption slows, governments step in to stabilize output through spending, transfers, and debt issuance. Japan did not accumulate debt to accelerate growth. It accumulated debt to prevent collapse. High savings, low velocity. For decades, Japanese households maintained one of the highest savings rates in the developed world. In a deflationary environment, holding cash was rational. Prices were stable or falling. There was no urgency to deploy capital. This created a unique loop. Households save, financial institutions recycle savings into government bonds, government spends to stabilize demand, and the central bank suppresses yields to keep the system solvent. Debt rises, but money velocity remains low. This is why Japan could expand its balance sheet for decades without triggering runaway inflation. Debt as a stabilizer, not a stimulus. In most Western narratives, debt is assumed to be stimulative. In Japan's case, debt became a shock absorber. It replaced missing private demand, absorbed demographic decline, and prevented deflation from turning into depression. Growth slowed, but the system did not break. Japan chose stability over dynamism, continuity over creative destruction. The key misunderstanding: Japan's debt is often compared to countries that rely on external financing. This comparison fails. Japan's vulnerability is not a sudden funding crisis. It is long-term erosion. Productivity growth stagnates, real wages lag, fiscal space narrows, policy flexibility disappears. Japan did not collapse under debt. It became locked inside it. And this is the distinction that matters. Japan is not an example of what happens when debt explodes uncontrollably. It is an example of what happens when a society chooses to carry debt indefinitely to preserve social stability in a world where growth can no longer be assumed. When the market stops signaling risk. Debt was domestic, funding was predictable, capital flight was absent. But stability has a cost. When debt is carried indefinitely, pressure does not disappear. It relocates. In Japan's case, it migrated into the bond market itself. From market to mechanism. Under normal conditions, government bond markets perform a critical function. They price risk. Yields rise when investors demand compensation. They fall when confidence is high. They transmit information. In Japan, that function gradually vanished. As deflation persisted through the 1990s and the 2000s, the Bank of Japan stepped beyond conventional policy. Interest rates were cut to zero, then below zero. But even that failed to revive demand. So the central bank crossed a more significant threshold. Yield curve control, stability by design. In 2016, the Bank of Japan formally adopted yield curve control, or YCC. Instead of targeting short-term rates alone, it committed to fixing long-term government bond yields and purchasing unlimited quantities of bonds to enforce that target. In practice, this meant the BOJ would override market pricing entirely. If yields attempted to rise, the BOJ bought bonds. If selling pressure appeared, the BOJ absorbed it. Risk was no longer priced, it was suppressed. The central bank as the market. Over time, the consequences became visible. The Bank of Japan accumulated over 50% of all outstanding Japanese government bonds. This is not a metaphorical dominance, it is literal. In some maturities, the BOJ became the only meaningful buyer. As a result, trading volumes collapsed, price discovery weakened, liquidity dried up. At times, benchmark JGBs recorded entire days with no trades at all. The bond market still existed, but only as a formality. Dead stability. This did not trigger panic. There was no crash, no disorderly sell-off. Instead, Japan entered a state best described as dead stability. Everything functioned, nothing moved. Yields were stable because they were controlled. Debt was serviceable because rates were capped. The system survived because it was sealed. But a sealed system accumulates pressure, and pressure, eventually, seeks an outlet. The moment the cracks appeared, that outlet did not come from investors, it came from reality. Global inflation returned after 2020. Energy prices surged, supply chains fractured, imported costs rose sharply. Japan could no longer pretend inflation was theoretical. Yet raising interest rates would threaten the debt structure built over decades. The Bank of Japan faced an impossible choice: maintain control and weaken the currency, or restore market signaling and destabilize the system. For years, it chose the former. And that decision redirected pressure away from bonds toward the currency. Japan did not solve the debt problem, it repriced a late-stage cycle. The bond market could no longer function as a true price discovery mechanism. Interest rates could not rise without destabilizing the state. Public debt could not be liquidated, defaulted on, or inflated away internally. This was not a temporary policy stance. It was the consequence of a full domestic cycle already completed. Japan had already passed through credit expansion, asset inflation, balance sheet collapse, and prolonged deleveraging. By the time yield curve control became permanent policy, the system was no longer trying to grow, it was trying to remain solvent. When internal adjustment mechanisms are exhausted, pressure does not disappear, it migrates. Currency is the last adjustment channel when rates are politically frozen. In an open economy, there are only three macro-level adjustment mechanisms: interest rates, fiscal contraction or expansion, and the exchange rate. Japan neutralized the first long ago. Interest rates were capped for decades, bond yields were administratively controlled, debt servicing costs were shielded from market discipline, fiscal tightening was constrained by demographics and politics, an aging population, rising social spending, and deep deflationary memory made austerity untenable. By process of elimination, only one channel remained operational: the currency. This is not a Japanese peculiarity. It is how late-stage debt systems behave once internal levers are locked. Interest rate differentials did the repricing. As global inflation surged, other central banks responded. The US Federal Reserve raised rates aggressively. Europe followed. Yield differentials widened sharply. Japan did not, because it could not. The mechanics were automatic. Capital flows toward yield. Capital exits repression. Between 2013 and 2024, the Japanese yen lost roughly 50% of its value against the US dollar. This was not a sudden collapse. It was a slow, controlled depreciation across multiple cycles. The yen became the release valve for pressures that interest rates could no longer absorb. Who benefits from a weak yen? A depreciating currency functions as an indirect fiscal instrument. For Japan, it produced immediate system-level effects. Exports became structurally competitive. Overseas earnings translated into higher nominal profits. Equity valuations rose for globally exposed firms. Tourism surged as Japan became a low-cost destination. This preserved corporate balance sheets, protected employment, and reduced the probability of mass insolvencies. From a system stability perspective, it succeeded. The cycle did not reset, but it did not rupture. Who pays the cost? Currency adjustment is never neutral. The burden shifted to households. Japan imports most of its energy, a significant share of its food, and key industrial inputs. A weaker yen raised import prices immediately. Inflation, dormant for decades, re-emerged. By 2023 to 2024, CPI inflation exceeded 4%, real wages declined, nominal wage growth lagged price increases. For a population conditioned by generational price stability, this was not just economic, it was psychological. The system remained solvent, but household purchasing power eroded. This was not a policy failure, it was a late cycle choice. It is tempting to frame this as mismanagement. It was not. Japan faced a constrained menu of outcomes. It chose corporate continuity over household purchasing power, system solvency over distributive equality, gradual erosion over abrupt collapse. The yen absorbed what bond yields could not. Debt did not disappear. It was translated from a balance sheet problem into a cost of living problem. Why? This is a structural signal, not a local story. Japan avoided sovereign default, banking collapse, and forced austerity. But it revealed something more fundamental. When debt reaches a certain scale, creditors cannot force discipline, interest rates cannot normalize, and default becomes politically impossible. Then purchasing power becomes the adjustment variable. Japan did not escape its cycle. It completed it internally and externalized the remaining pressure. That distinction matters. What once looked uniquely Japanese now looks sequential. By this point, Japan no longer appears anomalous. It appears chronological. High debt, aging demographics, weak growth, monetary repression, Currency adjustment. For decades, Japan was described as an advanced economy that broke the rules, yet somehow avoided collapse. That interpretation is becoming increasingly difficult to sustain, because the conditions that shape Japan are no longer confined to Japan. They are emerging elsewhere, in the same order. Demographics, the first constraint of this cycle. Japan was the first major economy to age rapidly, after completing its post-war growth cycle. That timing mattered. An aging society produces predictable economic effects: slower consumption growth, higher savings preference, rising pension and healthcare obligations, political resistance to fiscal tightening. These are not cultural phenomena. They are demographic arithmetic. Japan encountered this arithmetic in the 1990s. Today, the pattern is spreading. The United States is aging more slowly, but persistently. Europe is aging faster, with weaker productivity offsets. China is aging at unprecedented speed, before reaching high-income equilibrium. The order is repeating. Japan was early. Others are now entering the same constraint. Debt from exception to environment. Japan's debt to GDP ratio remains the highest among advanced economies, but what once looked extreme now looks contextual. US federal debt exceeds 120% of GDP. Several European states remain structurally indebted. China's total debt, public and private, has expanded rapidly since 2008. The critical variable is not the headline number. It is the interaction. High debt, low growth, aging populations. Together, this combination compresses fiscal flexibility. It limits policy options. It narrows the aid adjustment corridor. Exactly as it did in Japan. Monetary policy convergence, not copying. Japan was the first to deploy policies once considered radical. Zero interest rates, negative interest rates, large-scale asset purchases, direct intervention in sovereign bond markets. These measures were dismissed as uniquely Japanese. Temporary responses to exceptional stagnation. Then came the global financial crisis. Then the pandemic. Then supply-driven inflation shocks. Central banks elsewhere adopted similar tools. Not identical in scale, but identical in logic. The shared constraint is structural. When debt levels are high, raising rates aggressively threatens system stability. Japan confronted this limit first. Others are now discovering it. The shrinking space for choice. Japan is often criticized for failing to reform, but that critique assumes optionality. In reality, Japan faced a narrowing set of feasible outcomes. Default was politically impossible. Austerity was demographically explosive. Sustained high inflation risked social rupture. Structural reform required time the cycle no longer provided. The outcome was not freely chosen. It was selected by constraints. This is the defining feature of late-stage systems. Policy becomes reactive. Stability becomes the objective. Growth becomes secondary. From outlier to reference point. Japan was once described as lost. Lost decades. Lost growth. Lost momentum. But perhaps Japan was not lost. Perhaps it arrived early at a destination others are still approaching. A world where stability replaces growth as the primary policy objective. Where monetary tools manage debt persistence rather than expansion. Where financial systems are preserved at the cost of dynamism. This is not a forecast. It is an observation grounded in sequence. The traits once labeled Japanese problems are increasingly global characteristics. Japan is no longer an exception. It is a mirror, showing what advanced economies look like once the full domestic cycle has already been run. Japan does not offer a solution. It offers something more uncomfortable, a map of limits. For decades, Japan was analyzed through the wrong lens. Observers asked why it failed to recover, why growth never returned, Why stimulus did not work? Those questions assumed the system was still trying to expand. It was not. Japan had already completed its domestic cycle. Credit expansion had peaked, asset inflation had collapsed, balance sheets had been repaired, demographics had turned. What followed was not stagnation by mistake, but stability by design. In earlier stages of growth, policy amplifies momentum. In later stages, policy substitutes for it. Japan's experience shows what happens when debt outpaces growth, demographics suppress demand, market pricing becomes destabilizing rather than corrective. At that point, policy no longer accelerates the system, it prevents it from breaking. Interest rates stop signaling opportunity, currencies begin absorbing stress, fiscal tools shift from investment to maintenance. None of this is ideological. It is mechanical. Japan avoided outcomes that define crisis, hyperinflation, mass unemployment, sovereign default, financial collapse. But the price of avoidance was subtle. Growth slowed, real wages eroded, dynamism faded. The system survived, the experience changed. This is the trade-off Japan reveals. Not collapse versus prosperity, but stability versus vitality. Japan is often framed as a cautionary tale, or alternatively, as proof that high debt does not matter. Both readings miss the point. Japan did not disprove economic limits, it demonstrated how those limits are managed. Debt was not eliminated, it was carried. Risk was not resolved, it was redistributed. Adjustment did not vanish, it changed form. Japan does not tell us what will happen next, it tells us what happens when. Growth slows permanently, debt becomes structural, policy replaces market discipline. In that environment, economies do not collapse, they harden. They become more stable and less flexible. This is not the end of capitalism, nor is it a path back to rapid expansion. It is a different phase of the system. Japan is not dead, but it is no longer young. It is living inside the constraints that modern economies eventually encounter. Once expansion gives way to preservation, Japan does not give answers, it gives perspective. And in a world where many systems are only beginning to test their limits, that perspective may be the most valuable signal of all.